Trideep Bhattacharya is Chief Investment Officer, Equities at Edelweiss Asset Management Company. He's joining us to take some questions. Trideep, good to have you here. Thank you very much for your time. Rates around the world are going up and markets are paying attention and repricing themselves once again, aggressively some days, less aggressively on others. I mean, is that the way you sort of put the markets in context, or you would believe that we are nearing the end of this down cycle? What's your sense?
Yeah, thanks for having me on your show. Always great to be here. I would actually kind of look at the market is delicately poised for the next couple of months for sure. And I would divide my thinking into two parts. I think the macro bit, the way it evolve over the next couple of months will decide the P multiple at which the stocks will trade over a period of time. This is in the context that we probably will see some sort of rate increase. Middle of the month, we will hear from Fed. And actually, today we also heard, Bank of Australia raising interest rates and whatnot. So as the interest rates go up, what is the right multiple for the market and the stocks, of course, is what will be decided probably in the month of June when most of the central banks have spoken. And in that context, I would say that probably 75 to 80% of the derating of the markets is already done. I mean, if you look at Indian markets, we have corrected on the PE multiple side quite a bit, not so much on the earnings, by almost about 20-25%. Today, 18 times 1 year forward is kind of in line with long-term average. And maybe we have some more room to go in the near term. All that will happen as we hear from the central banks in the next few days or so. Then we come to micro, which is basically the bottom-up part of how we are looking at the stock. And there we think that in the immediate short term, we might see actually earnings downgrade happen, like we saw about 2% in the March quarter result season. We might see a little more in June quarter. But in this whole thing, from a bottom-up perspective, the way we are thinking about is we want to position ourselves in that part which of the market which offers reasonable valuations and has slightly higher earnings visibility than that of the rest. So that's how kind of I would summarize the market for you in the way we are thinking about it.
All right. And in that, what would your sector-specific calls be? What are the sectors that you're backing from here? What are the stocks that you're backing? I mean, case in point, something like the manufacturing space. A large part of the street does believe that this has been under-owned. This may prove to be a big investment opportunity going ahead as capex picks up. As we speak, Honeywell is one of the stocks which is now moving to the high point of trade. The other pack that people talk about is the auto space as well. The last few years of underperformance now coming undone because of valuations being attractive, the worst of inflation perhaps being behind them, and supply chain woes too. Your thoughts on sectors?
So basically, as I said, bottom up, we are looking at pockets which are reasonable on valuations as compared to their 5 to 10 year history, and there is decent earnings visibility. And I would say in that context, industrials, financials, and direct and indirect plays on real estate come actually to the forefront. Areas where if you look at over the last 10, 15 years, the valuations are still reasonable. And if you look at in the context of the capex cycle that might come through over the next 2 to 3 years, still offer decent earnings visibility. Those are the areas actually we have been overweight and we continue to remain so. While areas where there is higher valuations, like for instance, mid-cap IT, still I would say despite the 25-40% correction, and also some parts of consumer staples are areas where we see that the valuations are still on the higher side, whereas earnings visibility or the risk of downgrade might be on the higher side as well. So we are kind of avoiding those in the context of our portfolios.
Trideep, any thoughts on the gold financing business? I'm referring to the industry leader Muthoot, but if you don't want to talk about the company, we can maybe run us through what you think of the business. Seen such a sharp derating. I don't know if the underlying business has deteriorated as much, but your thoughts?
I think as rates go up on a relative basis, NBFCs and all sections of NBFCs also will find life a little tougher than that of banks overall, and will have some part of their competition or some part of their kind of demand scenario eaten away by the banks. Within that, gold is relatively insulated because it's relatively niche overall. But I would say that, in general, in the context of financials, we would be positive on lending financials more so than actually lending banks more so than the NBFCs overall. Partly because as it happens, the rates go up and how the various sections of the financials react to them because of the cost of funds and stuff like that. Beyond that, can't go more stock specific.
All right, and a larger point there itself in the financial space. What are your thoughts? Because I mean, day in, day out, we do get regulations coming in which indicate that NBFCs will now be treated at par with banks so far as disclosures are concerned, so far as capital allocation is concerned. And with the interest rates increasing from here on, do you think margins are at risk? Do you think capital is at risk? Do you think the best of NBFC growth is behind these companies?
I wouldn't kind of go that far ahead. I genuinely think that over the next 2 to 3 years, we have a story in India of domestic cyclicals coming through. And as we see domestic recovery happen over a period of time, the lending growth will stand to happen. The reason and the credit growth indeed has picked up. While we haven't seen that as much reflected in the banking shares, the reason that it is most of the growth so far is funded by internal cash accruals. I think if you give it 6-9 more months, you will see lending also pick up, and it will benefit banks as well as NBFCs. And within that, I would probably say that banks would be probably bigger beneficiaries than that of NBFCs. So yes, there could be on net balance incremental pressure on NIMs, but would be compensated for growth. With regards to asset quality, I think we've come through a good bit of deleveraging in the cycle for corporates in India. If at all there is any pressure in asset quality, it will be more transient in nature. So I'm not worried about asset quality as much. I am more interested in those financials which can capture the upside with regards to the economic growth that they will come through in the form of lending and the liability franchise ultimately leading to better margins or better NIMs as compared to that of competition. That's where the wealth creation, in my opinion, within financials will happen over the next 2 to 3 years.
Just by the way, market breadth is 2.5:1 in favor of declines. And I'll just mention a few names here. So Policy Bazaar we've discussed. Titan is down about 5% right now. Dr. Reddy's is down 5%. Zomato came up earlier, 6% lower. Gujarat Gas is down about 4.5% right now. Z is down 4%, 238, 240. UPL is another one which is selling off 4%. NBFC's LIC Housing is down 4%. ICICI Lombard is down 4% as well. Raymond, which had a big move day before yesterday, was down yesterday 7%, was down 4% today. Dalmia Bharat is down about 4%. Ramco is down 3.6%. MRF is down 4%. Greaves Cotton continues to sell off. That deal in terms of the investment of the EV arm came out last Thursday evening. Friday it opened sharply higher before selling off. It sold off yesterday. It's down today as well. Glenmark is down 3%, and so on and so forth. Trideep, just again, like Muthoot, another name which has kind of done very poorly is ICICI Lombard, right? Lots of hopes on this one. It's a sunrise sector, general insurance, leader, used to be great execution. What's gone wrong here? Your thoughts?
So again, can't get company specific, but the framework that I laid out for your investors is true to, in my opinion, follow over the next 3-6 months, which is, in this cycle, understanding where valuations are in the context of history is important. Some of the consumer discretionary names, which they're trading at very high valuations, and you name some of them, wherever there is a risk of earnings downgrade, even to a certain extent, are seeing kind of, a downside. Likewise, wherever there is earnings disappointment, that will be kind of brutally punished in such circumstances. So basically, in a situation where rates go up, valuation multiples will be scrutinized to the hilt, and also any kind of earnings misses will not be excused. In the names that you mentioned, without getting company specific, some of them, if not all, have been examples where there have been earnings misses, or the valuations are still kind of, quite lofty as compared to where they have been over the last 5 years. So be mindful of those two kind of, elements while picking stocks in this environment, basically valuations and earnings visibility.
And earnings visibility. Well, the auto space has really been on an outperformance fire, so to say. Tata Motors is the one now which is surging as we speak. M&M, of course, continues to do well. M&M currently, actually, as we speak, is just about 1.5% away from its all-time high, which it hit last week itself. And then giving it company, we have Hero MotoCorp as well as Maruti. Both these stocks sitting at the high point of trade. We take a short break.